kind of a lot to unload there. Let me pull them up real quick. U.S. So a lot of stuff came out, and I'll kind of try to clump it together in categories to kind of keep it, reasonable. Retail sales came out. They rose to a seasonally adjusted 0.9% in April from March. So kind of what you were mentioning, Brian, there's been mixed. Some have still been positive. I say one of the positive aspects, which I think is going to be a driver on, if we are going to have a recession, when is it going to occur, has been retail sales, has been spending. And we're always lagging by a month or two, but those numbers still look pretty strong. I think the May and June numbers are going to be more telling. But once again, U.S. retail sales rose. Those still look strong. Consumer prices rose, which is inflation, 6.3% in April from a year earlier. The positive aspect of that is actually down 6.6% from the March reading, or from 6.3 from 6.6. So it dropped 0.3% from the March reading. So we're seeing a slight slowing of inflation. But the core PCE index, which is what the Fed looks at, and that excludes volatile categories such as food, energy, that increased 4.9% year over year in April, and that was down from 5.2% year over year in March. So that's positive. Inflation slowing is hopefully a good sign. Obviously, it needs to slow a whole lot more. People are still feeling it, and it could accelerate, but hopefully it's peaked. The job market continues to remain strong. Employers had an estimated 11.4 million job openings through late May. So still an extraordinary amount of jobs out there. The unemployment rate remained at 3.6%, which is right near where we were at right before the pandemic hit, which was 3.5%. So the job market continues to be really strong. We're seeing some good signs of inflation slowing potentially, and spending has been up. So there are some positive aspects of it. U.S. durable goods orders rose 0.4% in April. That was driven up mostly by aircraft orders. When you exclude the defense aircraft orders, it rose 0.3%, so a little bit more modest there. I think one of the things that has been in the spotlight, especially with rising interest rates, has been the real estate market. So pending home sales fell 3.9% in April from March. A lot of that was due to tight inventories. You have very little inventory on the market as people are not really looking to maybe put their place on the market or sell due to higher interest rates now. The S&P CoreLogic Case-Shiller National Home Price Index rose 20.6 year over year in March from 20% annual rate in February. So what we're seeing is, what the news is even reporting, is home sales are falling, and that is true just because inventories are so low, but we have yet to really see a dip in home prices. Those continue to rise. Yeah. And actually the median existing home price rose 14.8% in April year over year to $391,200. And that's a record high since 1999 they began tracking.
Amazing.
So, the real estate market is it's almost in a conundrum, right? We're seeing a slowdown of transactions occurring, but prices have not alleviated yet.
Yeah.
And then mortgage rates kind of continuing on that. One positive sign is they dropped for the second week in a row towards the end of May. So they kind of peaked beginning of May at 5.3%. And last they dropped down, they were more settling around 5.10%. So that's positive. And what we're seeing there is a kind of a stabilization in the mortgage rates. And that's positive for the overall market. When you have volatility in the fixed income markets, which we've seen a lot of this year so far, it causes a lot of uncertainty.
Sure.
And then the last thing I'll mention, the national average price for a gallon or regular unleaded gas hit $4.62, as reported by AAA. That's $1.58 higher than a year prior, and 12% above the pre-2020 high of $4.11, or 2022 high, of $4.11 in 2008. And I will remark on that. I was on a call yesterday with associate in California. He said in Los Angeles, a gallon of gas was going for between $7 and $7.50 a gallon, which is pretty crazy.
It is crazy. Well, and that inflation, Chris, is obviously something that is a risk for the economy. We've already seen investors take money out of savings. Consumer numbers continued strong in April. We haven't received numbers yet for May, but we'll get them very soon. But some of the spending, it's clear, is now coming from savings. And we've also seen a rise in credit as well, as people are putting more in their credit cards. So eventually something's got to give there. And hopefully that people don't get over levered and they take away too much of their savings. So, but as of now, we haven't seen a big consumer decline. Chris mentioned home prices continue to rise. That's inventories. There's not many houses out there. And then, inflation in a lot of other areas as a result of oil and a result of the supply chain issues from the pandemic that are still here. So I don't think we've seen this combination of strangeness in the economy ever in American history. We've only recovered from a pandemic once, and that was 1918. And we really didn't have the kind of financial markets that we have now. So, they say this time is different and people debunk that, but there are some differences this time for sure. We've not dealt with inflation since the 70s. We didn't have a pandemic in the 70s. We didn't have them both together. So a lot of strange things. The retail stocks, though, Chris, are reflecting a slowdown. Retail stocks got slaughtered. Real estate sales have been slow, as you mentioned. And we're seeing some of their signs of a tough economy and a negative quarter, but still decent job growth in certain areas, although technology firms are starting to lay people off. So, and then they're getting hit the worst, and that's reflected by their stocks. The labor force participation rate is at all-time lows. So that means a lot of people that wouldn't normally work and come back to work in those 11 million jobs, Chris, you mentioned, that are open. They're not coming to work for a number of reasons. And many economists think that as people spend time at home, many people might be retiring early and not really disclosing that. There are a lot of folks that are not working, and maybe they just got used to not working. So we developed some either different habits or different views of work. So there's this big gap between all the people that are not working and all the jobs that are open. So we'll see how that all ends up playing out. And then there was a discussion also about how inflation was transitory all through last year. And now Janet Yellen admits that she was wrong about inflation, didn't understand this would unleash such a bad inflation, all the spending. Many people think that she did know it and she was just playing politics. I'll leave that up to the listener to decide that. But nonetheless, now they're admitting that they were wrong about inflation, and it's a huge problem. So the economy is got many different inputs, as you mentioned, Chris. It's kind of all over the board right now, generally going higher, but certain negative things that are coming in. So we'll see what the next month brings and how the markets react to it.